Imagine putting $100,000 of your retirement savings into this, supposedly safe premium investment fund.
Right, a really solid chunk of change.
Exactly. And every single quarter, you get a statement. And it shows this beautiful, steady, like 11% yield. I mean, it basically feels like a financial cheat code.
Oh, yeah. 11% is huge, especially these days.
Right. So you're feeling great. But then one day you decide you need a chunk of that money. Maybe $20,000 to put a down payment on a house.
Or like an unexpected medical bill or
Yeah,
something.
exactly. Real life happens. So you go online, you click the button to withdraw your funds, and the billionaire asset manager running the portfolio basically looks you in the eye, legally speaking, and just says, no.
It is a terrifying realization for an investor.
I can't even imagine.
Suddenly the money you thought was yours, it's just locked behind this contractual wall, and you have absolutely no idea when or even if you're going to get it back in full.
It's wild. So today, we're opening up the hidden, really high-stakes plumbing of private credit and alternative investments. We want to show you exactly how that scenario actually happens.
Because it's happening a lot right now.
It is. We're looking at a corner of the financial world that has just exploded in popularity, sucking in, literally billions of dollars from everyday retail investors who are just chasing that yield.
Yeah, people looking for anything better than a standard savings account.
Exactly. Specifically, we're going to dissect business development companies, or BDCs.
Right, and we'll be putting a microscope on Blackstone's BXSL fund specifically. And we're going to contrast that with the recent, highly publicized controversy surrounding those massive funds managed by Blue Owl and BlackRock.
Yeah, the ones that made all the headlines. So our sources for this deep dive are a towering stack of detailed financial analyses, recent institutional case studies, and some really granular Q&A breakdowns of real-world fund mechanics.
It's a lot of data to come through, for sure.
It really is. But our mission today is to decode how these high-yield alternative investments actually generate those double-digit returns. And, why some investors suddenly found themselves trapped in a liquidity squeeze.
And critically, how you can spot the structural differences between what is a once-in-a-decade financial opportunity and what is just a cleverly disguised trap.
Because there is a huge difference.
Huge. And the distinction, honestly, it often comes down to the fine print of the fund's architecture rather than, the underlying assets themselves.
Right. The plumbing matters more than the water sometimes. So to the listener, if you are someone trying to navigate this brutal high interest rate environment, maybe you're yield hunting, or maybe you're just like intensely curious about how private equity titans engineer their debt vehicles, consider this your survival guide.
Yeah, we're definitely turning a complex financial maze into a clearer roadmap today.
Let's start with the shockwaves. The moment the music basically stopped for a lot of investors.
The liquidity squeeze.
Yeah. Over the last couple of years, we watched heavyweights in the private credit market, specifically Blue Owl with their OCIC fund, and BlackRock with their BCIC fund. They just restricted or outright halted investor redemptions.
Right. People asked for their cash, and the gates slammed shut.
Exactly. Can you explain that? What is actually happening there?
So the industry term is a redemption gate. And to understand why a massive firm like BlackRock would take such a drastic, reputation-damaging step, we have to look at the mechanical structure of these specific non-traded funds.
Okay, lay it out for me.
Basically, a redemption gate is a predefined contractual cap on how much capital is allowed to leave the fund during a specific time period.
So it's baked in from the start.
Completely baked in.
Yeah.
A standard cap might be, say, 5% of the fund's net asset value or NAV per quarter.
Okay, let me do the math. So if a fund is managing like $1 billion of investor capital, they have hardwired a rule saying only $50 million can walk out the door in any given 3-month window.
Exactly. And that $50 million, that is a hard ceiling. It does not budge.
Wow.
So if the collective requests for withdrawal in that quarter hit 10% of the NAV, so $100 million, the fund manager drops the gate.
And what happens to the investors who asked for their money?
Well, they do not honor requests on a first-come, first-served basis. That's a huge misconception. They implement what's called a pro rata reduction.
A rata, so they just slash everyone's request equally.
Exactly. If you requested your entire $100,000 balance and the fund received double the withdrawal requests it is actually allowed to process, you are only getting $50,000.
Wait, seriously?
Yeah. The remaining 50,000 is forcibly retained inside the fund.
I mean, the obvious question an investor asks here is, why on earth would a financial institution build a trapdoor into their own product? It feels so antagonistic.
It does feel that way.
But looking at our sources, this isn't just about trapping investors for the sake of collecting more management fees, right? It's a defensive mechanism.
Yeah, it's a defense against a massive structural flaw. The flaw is known as an asset-liability mismatch.
Asset-liability mismatch. Okay, break that down.
This is the gravitational force governing everything in private credit. To see it, you basically have to split the fund in half. Let's look at the asset side first.
Okay.
What is the manager actually purchasing with that $1 billion of pooled capital? They are originating highly bespoke, highly illiquid private loans to middle market companies.
Right, so we're talking about $50 million or maybe $100 million loans to, I don't know, regional healthcare providers or specialized software developers, or maybe mid-sized manufacturing firms.
Exactly. And the key word there is illiquid. These aren't publicly traded bonds.
You can't just jump on E-Trade and dump them.
No, you can't open a Bloomberg terminal, click a button, and sell a specialized loan to a sauce company on a random Tuesday morning to generate cash. There is virtually no active secondary public market for these private corporate loans.
You're stuck with them.
Basically, yeah. The entire business model assumes these assets will be held to maturity. The borrower makes regular interest payments, and eventually, in say 3 to 7 years, they pay back the principal.
Okay, so that is the asset side. It's highly illiquid, slow-moving, long-duration paper.
Correct. Now let's look at the liability side. The fund's liabilities are the obligations it has to its shareholders, the people who gave them the money.
And to convince high-net-worth retail investors to hand over that money, these funds heavily marketed the promise of quarterly liquidity.
Exactly. They told investors, hey, you can tap into this lucrative world of private equity lending, but don't worry, you can still get your cash out every 3 months if you need it.
Which, when you think about it, is a totally contradictory promise. You are financing deeply illiquid, multi-year corporate debt using short-term liquid retail capital.
It's inherently unstable.
Let me try to visualize this with an analogy from our notes. Let's imagine the private credit fund is a massive municipal water reservoir.
Okay, I like this one.
Right. So the assets, the actual loans to those middle market companies, they are gigantic frozen blocks of ice sitting in the reservoir.
Solid ice.
Solid ice. They have immense value, but they are solid. You can't drink them. They require time to naturally melt into liquid water as the borrowers make their monthly interest payments and eventually pay back the loan principal.
And that natural melting process, it's slow, but it's highly predictable under normal macroeconomic conditions.
Right. But the liability side, the marketing promise to the investors, is a guarantee that this reservoir will provide a steady, reliable flow of liquid water on demand every single quarter.
So the fund manager builds their models assuming, well, only a small fraction of the town will show up with buckets at any given time.
Exactly. As long as the withdrawal requests are low, the natural melting of the ice provides enough liquid cash to satisfy everyone.
But the model breaks completely when macroeconomic weather changes.
The storm hits.
Right. If interest rates spike or the stock market crashes, fear enters the retail market. Suddenly, a massive crowd of investors runs to the reservoir, demanding their liquid water all at once.
And the ice hasn't melted?
Exactly. The cash literally does not exist within the fund, so the manager is forced to weld the gates shut.
Okay, but when that happens, investors are furious. But our sources talk about this concept of fiduciary duty, which kind of completely changes the moral framing of the redemption gate, doesn't it?
It does. It completely flips it. When a manager drops the gate, retail investors naturally feel betrayed. But if the manager fails to drop the gate, they're actually committing a severe breach of their legal obligations to the remaining shareholders.
Because if they don't lock the doors, they are forced to liquidate the ice blocks.
They have to initiate a fire sale.
A fire sale on private debt sounds awful.
It's a catastrophic fire sale. Think about it. If the fund needs $100 million in cash immediately, and there is no active market for those private loans, the manager has to call up specialized institutional buyers and literally beg them to take the debt off their hands.
And those buyers, they smell blood in the water. They know the fund is desperate.
Yeah, absolutely. So a perfectly performing loan, a great loan, with a face value of $10 million, it might have to be sold for $7 million just to generate liquidity today.
Wow. So the fund takes a permanent 30% loss on a totally healthy asset purely because of a manufactured liquidity crisis.
Exactly. And because of that loss, the net asset value of the entire fund plummets.
So everyone suffers.
Right. The manager is effectively burning down the house to appease the people running for the exit, which destroys the wealth of the investors who calmly decided to stay.
Ah, I see.
So fiduciary duty mandates that the manager must protect the entire pool of capital. Dropping the redemption gate is honestly the only legally sound way to stop the value destruction.
Okay, it is the financially responsible move. I get that. But it creates a psychological nightmare in the broader market.
Oh, massive panic.
Yeah. Like if I am an investor sitting in BlackRock's private credit fund and I read in the Wall Street Journal that Blue Owl just gated their investors, I'm not going to sit around analyzing my fund's liquidity profile.
No, you're going to panic.
I am going to assume my fund is next.
And the industry calls this the contagion of preemptive redemptions.
Preemptive redemptions, meaning I pull my money out today, not because I actually need the cash, but purely to beat the gate that I assume BlackRock is going to drop tomorrow.
Exactly. It is a classic bank-run mentality just ported over to alternative investments. And the tragic irony is, by doing so, you and thousands of other anxious investors artificially create the exact liquidity crisis you are afraid of.
It's a self-fulfilling prophecy.
It really is. The fund is swamped with requests, the cash buffer is depleted, and the manager is forced to drop the gate on a portfolio that might otherwise be performing flawlessly.
The entire system just feels so precarious when you frame it that way, which means we really need to understand the architectural foundation that makes this whole Highwire Act possible.
Yeah, we have to look at the vehicle itself, the Business Development Company, or BDC.
Right, because the BDC is a highly specialized legal wrapper, right? It's the conduit that allows retail capital to actually flow into the private credit markets in the first place.
Exactly. And to understand why it even exists, we have to look back at the Investment Company Act of 1940.
1940, we're going back a bit.
Just for a second. Fast forward a few decades from that initial legislation, and lawmakers realized there was this massive funding gap in the American economy.
A gap for middle market companies.
Right. If you were a giant corporation like Ford or General Electric, you could just issue public bonds to raise billions.
Sure.
And if you were a tiny mom-and-pop bakery, you could get a small business loan from your local bank. But if you were a middle market company, say, generating 50 to 500 million in revenue, you were stranded.
You're in the donut hole.
Exactly. You were too small for the public bond markets, but way too complex and asset-light for a traditional commercial bank, especially after banking regulations started tightening up.
Historically, lending to that middle tier was an exclusive country club, right?
Very exclusive. Only massive private equity firms and elite institutional investors had the capital and really the risk appetite to play in that space.
But the government wanted to democratize that access. They wanted to spur investment in mid-sized American businesses. So they created the BDC structure.
Right. It allows an asset manager to pool money from regular, everyday investors and lend it out to these mid-sized companies.
And this is the key part, the government knew retail investors needed a serious incentive to take on that kind of risk.
And that incentive is a massive structural tax advantage. It's called the 90% rule.
The 90% rule. Okay, this is the absolute core of the BDC machine. Looking at the sources, this rule is the engine generating those massive double-digit yields. Walk us through it.
Okay, so under normal circumstances, an American corporation is subjected to double taxation.
Right, everybody hates double taxation.
Exactly. The company earns a profit and pays a corporate income tax. Then whatever is left over might be distributed to shareholders as a dividend. And then the shareholder pays personal income tax on that dividend.
The government takes a bite out of the apple twice.
But a BDC bypasses the first bite entirely. As a regulated investment company, a BDC pays zero corporate income tax.
Zero. That is a massive privilege.
It is. But to maintain that incredible privilege, the government demands a heavy trade-off. The BDC is legally required to distribute at least 90% of its taxable income to its shareholders in the form of dividends every single year.
Wow. So they are structurally forbidden from hoarding cash.
They literally cannot hoard it. They collect hundreds of millions of dollars in interest payments from the middle market companies they lent to. They pay their internal management fees. And basically everything else must be flushed directly into the brokerage accounts of the retail investors.
That is wild. The capital efficiency is remarkable. And I guess that forced distribution is why a BDC might yield 10 or 11%, while, you know, a standard S&P 500 index fund yields what, less than 2%?
Exactly. It's a pure yield machine by design.
Okay, I think we need to draw a very hard line here for the listener because the branding in this space creates a lot of confusion. There is a fundamental difference between investing in the parent company that manages the fund versus investing in the fund itself.
Yes, the restaurant versus the signature dish analogy. I love this one.
Let's lay it out. You can open your brokerage app right now and buy shares of Blackstone Inc., the parent company, under the ticker symbol BX.
Right.
When you buy BX, you are buying an equity stake in the restaurant itself.
You're an owner.
Yeah, you make money when the restaurant opens new locations around the world, when they launch new marketing campaigns to attract more diners, and critically, you profit from the management fees they charge every single person who walks through the door.
You are buying a global alternative asset manager. Your returns are driven by their ability to grow their assets under management.
So if the stock market is booming and pension funds are throwing billions of dollars at Blackstone to manage, Blackstone makes a killing in fees, regardless of how the underlying individual loans are actually performing.
Yes, exactly. But if you buy a BDC managed by Blackstone, like their traded fund BXSL or their non-traded fund BCRED, you are not buying the restaurant.
You are buying the signature dish.
Right. You do not get a cut of Blackstone's global management fees. In fact, you are the one paying those fees.
That is a crucial distinction. Your returns are entirely isolated to the ingredients of that specific dish.
Your profit comes solely from the interest payments made by the specific portfolio of middle market companies that the BDC lent your money to.
So if those software and manufacturing companies pay their interest, you get your yield. If those companies default, your investment goes to zero, even if Blackstone as a parent company is having like a record-breaking, massively profitable year.
It is a pure play on private credit yield and default risk, totally divorced from the operational success of the asset manager.
Okay, so if a BDC is basically just a giant bucket of mid-market loans legally forced by the government to bleed out 90% of its cash as dividends, how do we explain the Great Divide?
The divide between traded and non-traded.
Exactly. Why do some of these buckets freeze your money and lock the gates, while others let you sell your shares instantly on an app? The underlying loans might be identical.
They could be practically identical. The difference lies entirely in the packaging. This is the structural schism between non-traded BDCs and traded BDCs.
Let's dissect the non-traded BDC first.
Right.
Funds like Blackstone's BCRD or Blue Owl's OCIC, you usually can't just buy these on a whim on Robinhood, right?
No, you generally have to go through a financial advisor or a wealth management platform. And when you want to get out, you are at the mercy of the fund itself.
Because they aren't on a public exchange.
Right. You are reliant on the company executing a share repurchase program, buying your shares back at the stated net asset value.
And as we established earlier, those repurchase programs are capped. That is exactly where the redemption gates live.
That's the trapdoor.
Now, traded BDCs like Blackstone's BXSL or Heirs Capital's ARCC, they are totally different. They are listed on public stock exchanges like the NYSE or NASDAQ.
Just like buying Apple or Amazon.
Right. So if I own BXSL and decide I want out, I don't have to ask Blackstone for permission. I just sell my shares to another investor on the open market, and I have cash in my account in milliseconds. There are no gates.
True, but the trade-off for that instant liquidity is the introduction of extreme pricing volatility.
Because of the stock market.
Exactly, driven by a phenomenon called valuation lag.
Let's explore that valuation lag, because the psychological element here is fascinating.
It really is. Look at the traded BDC. Its price is dictated by a live ticker. It fluctuates every second based on the collective panic, exuberance, and frankly, irrationality of the global stock market.
Right.
So if a negative macroeconomic report comes out and the S&P 500 tanks 3%, your traded BDC will likely sell off right alongside it. The underlying loans to those software companies haven't changed at all, but the market price of the BDC plummets.
So to an investor watching their portfolio, it looks terrifyingly volatile. The line on the chart is jagged and scary.
Very scary. Now look at the non-traded BDC. It holds the exact same types of loans, but there is no public ticker.
Right.
Its price, The net asset value is calculated periodically, often just monthly or quarterly, by a team of accountants and valuation experts.
Or they just do the math in a room somewhere.
Basically, they look at the loan portfolio, confirm the borrowers are still making their interest payments, and declare that the NAV remains steady at, say, $25 a share.
So it creates an artificial smoothing effect.
Precisely the term. The accounting mechanism filters out all the daily noise of the stock market. To the retail investor, the non-traded fund looks incredibly serene.
It's just a beautiful flat line that consistently throws off a 10% dividend. It feels inherently safer than the traded BDC because you don't have to watch the price jump around. But it is psychological illusion. We talked about this before the show. It's the equivalent of taping a piece of cardboard over your car's speedometer.
I love that analogy.
Your speed is still fluctuating wildly based on the terrain you're driving over. But because you can't see the needle moving, you feel perfectly calm.
And the illusion holds up beautifully. Right until the terrain actually gets rough, the investor demands their money back, and they crash headfirst into the redemption gate.
Okay, let's walk through the brutal reality of what happens when that illusion shatters.
It gets ugly.
Say you are a retail investor. You put $50,000 into a non-traded BDC. You get spooked by the market, you submit a withdrawal request, and the fund hits you with the pro rata gate. They say, sorry, we can only give you $2,000 this quarter. What are your actual avenues of escape?
The options are highly punitive. Your first option is just passive endurance.
Just wait it out.
Yeah. You stay in the queue, you take your $2,000, and you submit another request for the remaining $48,000 next quarter. And if the gate remains saturated, which it often does during a panic, it could take you 20 consecutive quarters, 5 full years, to fully extract your capital.
5 years of your money being held hostage. And during those 5 years, you suffer a massive opportunity cost because you can't redeploy that capital into better investments.
Furthermore, you remain fully exposed to the underlying credit risk the entire time you're waiting.
Oh, right, because you're still invested.
Exactly. If the macro environment continues to deteriorate while you are waiting in line, the mid-market companies in the portfolio might start defaulting. The net asset value will drop, meaning the cash you eventually pull out in year 4 will be significantly less than what your shares were worth in year 1.
That is just agonizing. So what is the alternative? Option B.
Option B is the secondary market. Just because the fund is non-traded doesn't mean it is completely non-transferable. There is this shadow market of specialized institutional buyers, often distressed debt funds, who aggregate and buy up stranded shares in private vehicles. But these institutions are predatory by design.
They are sharks. They know you are trapped. They know you are desperate for cash.
Exactly. So they will not offer you the stated $25 NAV for your shares. They will demand a massive liquidity discount. They might offer to take your shares off your hands instantly, but at a 20, 30, or even 40% haircut.
Wait, 40%. So you have to voluntarily accept a $20,000 loss on your $50,000 investment just for the privilege of accessing your own money today.
Yes. It is a massive wealth transfer from the impatient retail investor to the patient institutional buyer.
Okay, I have to step in here and challenge the entire premise.
Go for it.
If I am a semi-sophisticated investor, and I understand the valuation lag, the smoothing effect illusion, the 5-year queues, and the 40% secondary market haircuts, why on earth would I ever allocate capital to a non-traded BDC?
It seems counterintuitive, right?
It seems insane. Why wouldn't I just buy the traded version on Robinhood, accept the daily stock chart volatility, and retain my right to hit the eject button whenever I want?
The rationalization comes down to a concept called the liquidity premium. In the financial markets, risk and reward are theoretically linked. If you agree to lock up your capital and surrender your right to daily liquidity, you demand to be compensated for that sacrifice.
Okay.
Historically, non-traded funds have offered slightly higher distribution rates, perhaps 1 to 200 basis points or 1 to 2% more than their publicly traded peers.
So I'm basically selling my liquidity for an extra 2% yield.
You are. But honestly, the popularity of non-traded funds is driven by more than just yield. It is heavily driven by the financial advisory industry itself.
How so?
Many wealth managers strongly prefer to allocate client capital into non-traded vehicles specifically because of the lockups and the smoothing effect.
Oh, wait, the advisors view the trapdoor as a feature, not a bug.
They view it as a behavioral guardrail. Let's be honest, retail investors are notoriously terrible at timing the market. They tend to panic and sell at the absolute bottom.
Buy high, sell low.
Exactly. By putting a client into a non-traded BDC, the advisor removes the client's ability to panic sell during a temporary market dip. The flat, smoothed-out NAV prevents the client from seeing red on their monthly statement and making an emotional mistake.
Wow. So the advisor is essentially treating the investor like a toddler, putting safety locks on the financial cabinet so they don't hurt themselves.
That's one way to look at it, yeah.
Which sounds great in theory, right up until the investor faces a genuine personal financial crisis and actually needs the cash, only to find out the advisor welded the cabinet shut.
It highlights the inherent tension in alternative investments. You are trading structural flexibility for psychological comfort and a marginal bump in yield.
Let's shift our focus to that yield itself. We really need to dissect the danger and the allure of these double-digit payouts. Let's look closely at Blackstone's traded BDC, BXSL. It has been boasting a dividend yield hovering around 10 to 11%. Now, in a world where people spend a decade getting literally 0% on their savings accounts, 11% is a siren song.
It pulls in capital like a magnet.
It really does. But we have to look under the hood. How does a BDC actually extract an 11% return from a middle market company?
We have to deconstruct the loan pricing formula. When a BDC originates a loan to a borrower, the interest rate is not just pulled out of thin air. It is typically a three-part equation.
Break the equation down for us.
The foundational layer is the benchmark rate. The vast majority of these private credit loans are floating rate instruments.
Meaning they aren't fixed.
Right. This means the interest rate the borrower pays is not locked in for the life of the loan. It moves up and down in tandem with broader macroeconomic policy. They are usually pegged to SOFR, the Secured Overnight Financing Rate, which is dictated by the Federal Reserve.
And over the last couple of years, SOFR has surged to around 4.5% to 5%.
Exactly. So before we even assess the risk of this specific borrowing company, the baseline cost of borrowing is already sitting at 5%.
That's a high floor. What's the second layer?
The second layer is the credit spread. This is the customized risk premium. The BDC's underwriting team analyzes the borrowing company's cash flow, their industry position, their debt load, and assigns a risk value.
Okay.
Depending on the company's health, the BDC will add an additional 4 to 6.5% on top of the SOF benchmark.
Okay, let's do the math here. A 5% SOFR base plus, let's say, a 5% credit spread. The mid-sized software company is suddenly paying 10% annual interest on a $100 million loan.
$10 million a year just in interest.
That is a massive drag on their free cash flow.
It is. And then there is the third, often overlooked component, OID, or original issue discount.
Let's spend some time on OID. Why does it exist?
Yeah.
Why not just increase the credit spread by another 0.5% if you want more money?
OID serves a dual purpose for the asset manager: guaranteed immediate return and accounting manipulation. Think of OID like closing costs or an origination fee on a residential mortgage.
Okay, I follow that.
So the BDC agrees to lend the company $100 million. But at the closing table, the BDC only actually wires the borrower $98 million. The BDC retains $2 million upfront. However, the borrower is still legally on the hook to pay back the full $100 million at maturity, and they pay interest calculated on the full $100 million.
Oh, wow. So the VDC manufactures an immediate, risk-free 2% return on day one before a single interest payment is even made.
Precisely. And when you blend that OID upfront cash, the floating benchmark rate, the credit spread, and the fact that the BDC applies its own layer of leverage, meaning they borrow cheap money from megabanks to lend out at these higher rates, you arrive at the math that allows the fund to distribute an 11% yield to the retail investor.
The math makes sense on a spreadsheet. But the reality of charging a mid-sized company 11 or 12% interest creates massive operational pressure on the business.
Huge pressure.
These companies are being bled dry by debt servicing costs. Which brings us to the flashing red light on the dashboard of every single BDC. Non-accrual loans.
Yes. This is the metric that separates the elite managers from the tourists.
What exactly triggers a non-accrual status?
Non-accrual is basically the polite accounting terminology for a loan that is effectively dying. Structurally, it is triggered when a borrowing company is 90 days past due on their scheduled interest payments, or when the fund's management team determines that full repayment of the principal and interest is no longer probable due to the deteriorating financial condition of the borrower.
So it is the purgatory phase right before formal bankruptcy proceedings.
Exactly. When a loan is placed on non-accrual, a catastrophic accounting shift happens. The BDC is legally required to stop counting the expected future interest from that loan as income on their financial statements.
Ouch.
And they also have to take a write-down on the value of the principal.
So the BDC's revenue drops instantly, which means they have less cash to pay out under that 90% rule we talked about, forcing them to cut the dividend to the retail investor. And the write-down shrinks the net asset value of the fund. It's a double blow.
This is exactly why you must track the non-accrual rate. The industry average for BDCs has been climbing, hovering around 2 to 4% of total portfolios as the high-rate environment squeezes borrowers.
But looking at the source data, BXSL Blackstone's traded fund has a non-accrual rate of just 0.6%.
It's remarkably low.
Less than 1% of their massive portfolio is in trouble.
Oh.
That feels almost impossibly low given the macro environment. How do they keep it that clean?
Well, part of it is elite underwriting, for sure. But as diligent investors, we cannot just accept a low non-accrual rate at face value. We have to interrogate the quality of the income that the BDC claims to be receiving.
What do you mean by the quality of the income?
A borrower might be current on their payments, keeping them off the non-accrual list, but how are they paying? This introduces the most dangerous hidden mechanism in private credit, PIK, payment in kind interest.
PIK. Okay, I want to use a consumer analogy here to make sure the mechanics of this are crystal clear for the listener.
Let's do it.
Imagine you have a massive credit card bill, and the monthly interest charge is $1,000. But you don't have $1,000 in your checking account. So you call the bank, and they offer you a PIK arrangement.
Go.
They say, hey, don't worry about sending us cash. We will just take that $1,000 of interest and add it to your total outstanding balance. You pay nothing out of pocket today, but your total debt grows, and next month, you will be paying interest on the interest.
That is a very accurate representation. PIK is a contractual safety valve. If a middle market company is experiencing a severe cash crunch, they can negotiate to pay their quarterly interest not in cash, but in kind, by increasing the principal balance of the loan.
Okay, let's follow the money here, because this is where it gets crazy. The borrower owes Blackstone $1 million in interest this quarter. They elect to use PIK. They send Blackstone $0 actual dollars.
Right, zero cash changes hands.
But on Blackstone's accounting ledger, they record $1 million of PIK interest income because the value of the loan theoretically just went up by $1 million.
Correct. The BDC books the revenue on paper. The NAV of the fund technically increases.
But here is where the logic just seems to snap. Go back to the BDC cheat code, the 90% rule. Blackstone is legally obligated by the IRS to distribute 90% of its taxable income to me, the shareholder. If Blackstone is recording this PIK interest as income on their books, but they aren't receiving a single dollar of actual cash from the borrower, where on earth did they find the cash to pay my 11% dividend?
You are highlighting the core systemic risk of a high PI portfolio. The BDC has basically created a massive cash flow deficit. They are booking paper wealth, but they owe you hard currency.
So how do they bridge it?
To bridge that gap, the BDC has to cannibalize its own structure. They might divert cash from healthy borrowers who are actually paying down their principal, or, much more dangerously, the BDC will draw on its own revolving credit facilities.
Wait, they borrow money from a bank.
Yes, they borrow money, increasing the fund's overall leverage, specifically to pay you a cash dividend based on imaginary paper interest they haven't actually collected from the struggling borrower.
That is terrifying. I mean,
Yeah.
it is literally borrowing from Peter to pay Paul. It completely masks the rot in the portfolio.
It masks it perfectly.
The borrowing company looks healthy because they haven't defaulted, and the BDC looks healthy because they're still paying the high dividend. But underneath, the underlying corporate debt is compounding exponentially, and the BDC is leveraging itself to maintain the illusion.
And if the borrowing company eventually hits a wall and files for bankruptcy anyway, the BDC doesn't just lose the original loan amount. They lose all of that accumulated compounded PIK interest that they already paid taxes on and borrowed money against to pay your dividend.
Wow.
It creates a massive crater in the fund's balance sheet.
So the takeaway for the listener is simple. Yield is meaningless without context. When you look at a BDC, you have to dig into the quarterly reports. If the PIK percentage is climbing, it means the underlying borrowers are starving for cash, and your dividend is being funded by financial engineering rather than actual business profits.
Trace the cash.
Trace the cash, and analyze how the manager behaves when the market turns against them. Which leads us to the mechanics of capital allocation.
Yes, let's move into that because this is where traded funds get really interesting.
We are going to look at the tactical warfare of managing a traded fund during a panic. The concepts of dilution, accretion, and a massive $250 million buyback executed by BXSL.
This scenario is a perfect demonstration of why the traded BDC structure, despite its terrifying daily volatility, can actually be a massive advantage for a ruthless management team.
Let's set the stage. It's early 2026. The market is completely melting down over the news that Blue Owl and BlackRock are gating their non-traded funds.
The contagion fear we talked about earlier.
Exactly. It spreads everywhere. Retail investors don't care about the nuances. They just want out of private credit. Because BXSL is a publicly traded stock, investors hit the sell button en masse. The sheer volume of selling pressure crushes the stock price. BXSL drops to $23.82 a share.
But internally, Blackstone's accountants evaluate the loan portfolio. The loans are still performing, the borrowers are paying cash interest.
Right.
The accountants declare that the true net asset value of the underlying loans is actually $26.92 per share.
So the stock market is pricing the fund at an 11.5% discount to its actual intrinsic value. The public market is basically screaming, "We don't trust your accounting, we think a wave of defaults is coming, and your loans are worth far less than you claim."
Exactly. Now, traditionally, BDC managers are heavily incentivized to constantly issue new shares to the public.
Always be raising money.
Right, because every new share sold brings fresh cash into the fund. The fund gets bigger, the total assets under management grows, and the manager's percentage-based management fee increases. Asset managers are obsessed with asset gathering.
But when the stock price plunged to that $23 level, Blackstone did something highly unusual. They completely halted all new share issuance. They turned off the money printer.
Which was the right move.
Why? Let me use a slice of cake analogy from our sources to explain the concept of dilutive issuance, and you tell me if the math holds up.
I am listening.
Imagine the entire BXSL portfolio is a massive premium cake. Based on the quality of the ingredients, the underlying loans, the accountants determine the whole cake is objectively worth $100. The cake is sliced into 10 equal pieces.
Okay.
Therefore, the intrinsic net asset value of each slice, each share, is exactly $10.
The math is clean so far.
Now, imagine the stock market is in a panic. The market is only willing to pay $8 for a slice. If the fund manager decides they want to make the cake bigger to collect more management fees, they bake some new slices and sell them to new investors for the market price of $8.
They issue equity at a discount to NAV.
Right. But think about what happens to the communal pool. They just mixed $8 worth of value into a pool where every existing slice was backed by $10 of value.
The total value of the cake recalculates.
The math averages out. And suddenly, the original investors look down at their plates, and their $10 slice has shrunk. It's now only worth $9. The manager effectively stole $1 of intrinsic value from the loyal existing shareholders and handed it as a discount to the new buyers.
That is the textbook definition of dilution. Issuing equity below NAV is toxic. It is arguably a breach of fiduciary duty because it actively destroys shareholder wealth purely to grow the manager's fee base. By halting issuance, Blackstone protected the existing shareholders from that value destruction.
But they didn't just play defense. They went on the offensive. They announced a massive $250 million stock buyback program.
Which is huge.
They took the fund's own cash, went into the public stock market, and started buying their own shares at the depressed price of $23.
Which is the exact inverse of the dilutive cake analogy. It is structurally accretive.
Walk through the math of accretion for us.
It is brilliant arbitrage. Blackstone is taking fund capital and buying a share on the open market for $23.82. But remember, they know that share represents a legal claim on $26.92 worth of healthy, performing corporate loans.
They're literally buying a dollar's worth of assets for 88 cents.
Exactly. And once they buy that share, they retire it. They tear it up.
The share disappears, which means the total pool of assets, all those performing loans, is now divided among fewer remaining shares.
The remaining slices of the cake instantly become thicker. The NAV per share mathematically must increase.
It's like magic.
Without originating a single new loan, without taking on any new credit risk from a borrower, Blackstone generated a risk-free return of over 11% on that capital, simply by exploiting the irrational panic of the public market. It is a far better use of capital than lending it to a new company.
But we have to ask where the $250 million came from. We established earlier that the 90% rule forces them to bleed out almost all their income. They can't hoard cash. So how do they fund a massive buyback like that?
They utilize two specific pockets of liquidity. First, principal repayments.
Okay, what does that mean?
When a mid-market company successfully pays off a $50 million loan at maturity, that $50 million is a return of principal, not taxable interest income. Therefore, it is completely exempt from the 90% distribution rule. Blackstone can retain that principal and use it to buy back stock.
Makes sense. What is the second pocket?
Leverage. The fund maintains massive, unused revolving credit lines with Tier 1 global banks. They can draw down on those lines.
Wait, hold on. They borrow money from JP Morgan or Citi at, say, 6% interest and use that borrowed cash to buy their own stock.
When their own stock is trading at a discount that implies a 12 or 13% yield, yes, it is a massive positive arbitrage. They are borrowing at 6 to earn 13.
But that feels incredibly risky.
Yeah.
If you are borrowing hundreds of millions of dollars from major banks during a market panic, doesn't that make the fund hypersensitive to a margin call? What if the banks get nervous about the macroeconomy and demand all their money back immediately?
That is the existential threat of using leverage, for sure, but it is mitigated by a strict regulatory framework. Under the Investment Company Act, a BDC is legally bound by the asset coverage ratio.
Define the ratio.
A BDC must maintain a minimum asset coverage ratio of 150%. In plain English, this means the total value of their assets must be at least 1.5 times larger than their total outstanding debt.
Okay.
If a fund borrows too much and their ratio drops to 149%, severe regulatory penalties kick in.
What kind of penalties?
Yeah.
Are they just fined?
Oh, it's worse than a fine. They are legally barred from paying any dividends to shareholders.
Oh, wow.
They are barred from executing stock buybacks, and the covenants in their bank contracts are usually breached, giving the banks the right to accelerate the loans and demand immediate repayment. It triggers a complete death spiral.
So it is the absolute red line. You do not cross it.
Never. Now, look at the data for BXSL during this period. When they announced the buyback, their asset coverage ratio was sitting at 177.1%.
So they were operating with a massive structural buffer above the legal minimum.
Right, they had tens of millions of dollars of headroom. That buffer is their armor. It proves they had the balance sheet capacity to absorb the newly borrowed money for the buyback without coming anywhere near the regulatory red line. The banks cannot issue a margin call or demand repayment as long as the BDC remains in compliance with those covenants.
So to summarize the tactical maneuver, the retail market panicked over liquidity gates and other funds. They dumped BXSL stock indiscriminately. Blackstone looked at their pristine balance sheet, utilized their buffer, borrowed cheap bank money, and aggressively bought their own assets at a massive discount, instantly enriching the shareholders who didn't panic.
It is the defining characteristic of a Tier 1 institutional manager. They weaponize market volatility instead of being victimized by it.
But all of this financial engineering, the buybacks, the leverage, the NAV calculations, it is entirely dependent on one fundamental truth. The underlying middle market companies must continue to pay their bills.
Exactly.
If the loans default en masse, the entire structure collapses, which brings us to the operational reality of private credit. Let's look at the ultimate safety nets these funds utilize to protect the portfolio.
The financial architecture is totally useless without the operational muscle to enforce the contracts.
We noted earlier that BXSL's non-accrual rate is a remarkably low 0.6%. In an economy where inflation and high rates are crushing small businesses, how is that statistically possible?
It comes down to structuring.
The sources point to two structural advantages in their portfolio. First, line positioning and sponsor-backed deals. Let's start with the legal positioning. 97.6% of BXSL's loans are first line.
First line dictates the absolute hierarchy of survival when a company dies.
Okay, paint a picture.
If a borrowing company completely exhausts its cash, fails to turn around, and is dragged into bankruptcy court, a judge orders the liquidation of the company's assets. The real estate, the intellectual property, the servers, everything is sold off.
And the proceeds go into a big pile on the judge's desk.
Exactly. First-line debt holders are legally positioned at the very front of the line to receive that cash. They must be paid 100 cents on the dollar before the second-line debt holders, the mezzanine lenders, or the equity owners see a single penny.
So even in a worst-case scenario where the company completely implodes, a first lien position acts as a massive recovery floor. You might not get all your interest, but you will likely recover 80 or 90% of your original principal because you get to strip the carcass first.
It minimizes the severity of the loss. But obviously, the goal is to prevent the bankruptcy entirely. That is where the sponsor-backed nature of the portfolio becomes absolutely critical.
The data shows roughly 90% of the companies BXSL lends to are sponsor-backed. Define the sponsor for us.
A sponsor is a mega-cap private equity firm. Institutions like KKR, Thoma Bravo, Apollo, or Carlyle.
Let's walk through how this ecosystem works. KKR finds a mid-sized payroll software company they want to buy. The price is $1 billion. KKR does not want to use $1 billion of their own cash, so they put down $500 million in equity from their own fund, and they call Blackstone's private credit desk to borrow the remaining $500 million.
Right. Blackstone originates the loan, KKR takes control of the company, and the software company's cash flows are now used to pay the 11% interest back to Blackstone.
Now, I want to push back on the supposed safety of this arrangement. On paper, these leveraged buyout loans are non-recourse, right?
Yes, the vast majority are legally non-recourse.
Okay, so let's play out the scenario. The payroll software company loses a major client. Revenues drop. They can't afford the massive interest payments to Blackstone. The company is heading toward default. Because the loan is non-recourse, Blackstone cannot pierce the corporate veil. They cannot sue KKR directly. They cannot access the billions of dollars sitting in KKR's main fund. Blackstone's recourse is strictly limited to seizing the assets of the failing software company. So logically, why wouldn't KKR just cut their losses, hand the keys to the broken company over to Blackstone, and walk away?
On a purely legal spreadsheet, they can absolutely walk away. But private credit is governed by behavior and reputation as much as by legal contracts. There is a deeply ingrained, unspoken rule in sponsor-backed lending.
Explain the behavioral trap KKR is in.
KKR's entire business model relies on the ability to borrow billions of dollars quickly and efficiently to execute future buyouts. If they maliciously abandon a portfolio company, allowing it to default and forcing Blackstone to take a massive loss, they are burning a bridge with one of the largest lenders on the planet.
Blackstone will blacklist them.
Not just Blackstone. The private credit community is an incredibly tight-knit oligopoly. Word spreads instantly. If KKR develops a reputation for walking away from bad debt, every other lender will either refuse to work with them or dramatically increase the credit spread they charge KKR to compensate for the abandonment risk.
Wow.
A private equity firm without access to cheap leverage cannot generate the returns they promise their own investors.
They become a pariah, so they have a massive existential incentive to protect the lender.
Precisely. So when that software company nears default, KKR faces a choice. Walk away and suffer reputational damage, plus lose their entire $500 million initial equity investment, or write a new check.
They inject $50 million of emergency equity into the software company purely to cover the interest payments to Blackstone, buying the company time to turn its operations around.
The BDC is effectively piggybacking on the deep pockets and the reputational terror of the massive private equity firms. That explains why the default rates are artificially low.
But what if the problem isn't just a temporary cash crunch? What if the company is fundamentally mismanaged? Throwing emergency equity at a broken business model just burns cash.
This is where we reach the apex of alternative asset management, the true differentiator between a passive lender and an active manager. It is Blackstone's operating partner infrastructure.
I am fascinated by this. Let's look at the reality of corporate distress. If a mid-sized company is burning down, the board of directors panics. They need a visionary CEO to execute a turnaround. But you cannot just post a job listing on LinkedIn and hope a turnaround genius happens to be looking for work. Top-tier executive talent is incredibly scarce and heavily embedded in successful companies. Where do these PE firms find elite CEOs on 48 hours notice?
They do not recruit them, they stockpile them.
Stockpile.
Firms like Blackstone maintain a proprietary closed ecosystem of elite talent. They are called operating partners or operating advisors.
Who are these people?
They are the heavy hitters of the corporate world. Former CEOs of Fortune 500 companies, retired senior partners from McKinsey or Bain who specialized in restructuring, tech founders who scaled a company and successfully cashed out. They are not standard, salaried employees of Blackstone. They are independent contractors kept on highly lucrative retainers.
They are an elite corporate mercenary force waiting for a deployment call.
That is exactly what they are. When a portfolio company breaches a debt covenant or starts bleeding cash, Blackstone does not just send a nasty letter from their legal department, they deploy an operating partner.
Just parachute them in.
They parachute this executive directly into the failing company, installing them as the chairman of the board or as an interim CEO with absolute authority.
But why would a former Fortune 500 CEO take a stressful job trying to save a drowning mid-market insurance company?
Because Blackstone controls the capital structure, which means they can offer asymmetrical compensation. They can grant the incoming CEO massive equity upside, the potential to make $10 or $20 million if they successfully restructure the company and engineer a lucrative exit. A standalone, middle-market company could never dream of affording that caliber of talent.
Let's ground this in a specific narrative from our sources. The Westland Insurance case study. This perfectly illustrates the transition from passive lender to active surgeon. Westland was a successful insurance brokerage, but they had taken on way too much floating rate debt. When the Fed hiked rates aggressively, their interest expense doubled. The cash flow was squeezed to the breaking point. They were teetering on the edge of a technical default.
Right. And a traditional commercial bank in that scenario would panic. They would freeze the company's credit lines, force a fire sale of assets, and try to recover whatever cents on the dollar they could.
But Blackstone didn't panic. They activated the network. What did the surgical intervention look like?
Blackstone deployed an operating partner who had spent decades executing roll-ups and consolidations in the insurance sector. This executive didn't just tweak the margins, they ripped the company open. They completely digitized the antiquated back-office operations, aggressively terminated redundant legacy systems, and stabilized the cash flow.
But Blackstone isn't a charity. They didn't fix the company just to be nice. They extracted a massive toll for their services.
They executed a debt-for-equity swap. Blackstone agreed to restructure the debt, giving the company financial breathing room to survive the rate hikes. In exchange, Blackstone demanded equity warrants. They took a percentage of ownership in the company.
They said, "We will save your life, but we get a piece of the upside when you recover."
And the execution was flawless. The operating partner stabilized the business, the valuation recovered dramatically, and Blackstone eventually exited the position. The result: they recovered 100% of their initial loan principal, protecting that 0.6% non-accrual rate, and those equity warrants paid off massively, generating an outsized private equity-style return for the credit fund.
They transformed a looming default into a massive financial win purely through operational dominance. Our sources highlight two specific profiles of these mercenaries that are in incredibly high demand right now, given the macroeconomic climate. The first is the AI value creator.
This is a highly specialized, modern role. Blackstone has lent heavily to the software and SaaS sectors, companies like Octane.
What does an AI value creator actually do when they drop into a company like Octane?
Their sole mandate is margin expansion through technological shock and awe. They are not there to gently introduce chatbots. They parachute in, audit every single workflow, customer service, coding, logistics, marketing, and aggressively deploy enterprise-grade artificial intelligence to automate as much human labor as possible.
The goal isn't necessarily just to fire people, though that happens. The goal is to exponentially increase the revenue per employee.
Exactly. By structurally widening the profit margins, they massively increase the total enterprise value of the company. And when the enterprise value expands, the underlying debt that Blackstone holds becomes significantly safer because the equity cushion absorbing any future shocks is much thicker.
It is proactive risk management through technological upgrades. Now, the second profile is much darker. The turnaround king.
This is the role required when a company hits the absolute wall.
The prime example in our sources is Thrasio. For listeners who don't know, Thrasio was the poster child for the zero interest rate era. Their entire business model was borrowing cheap money to buy up hundreds of independent merchants selling products on Amazon. They were an aggregator. During the COVID e-commerce boom, they looked like geniuses. But when supply chains normalized, consumer spending shifted, and interest rates spiked, the model imploded. Thrasio was burning through cash and heading straight for bankruptcy court.
You cannot send an AI specialist into that kind of chaos. You need a turnaround king.
What did that executive do on day one?
They manage the corporate triage. Their career is built on navigating the vicious legal landscape of bankruptcy. They immediately begin aggressive negotiations with hostile creditors. They identify and liquidate non-core or toxic assets. They sever bad contracts, and they dig through the wreckage to find the viable, cash-generating core business hidden underneath the bloat.
They stabilize the patient so the financial engineers can safely restructure the debt without the company bleeding out on the operating table.
It requires a profound level of ruthlessness and legal acumen. It is corporate surgery in a war zone.
And having that surgeon on speed dial is exactly why these massive funds can lend to risky companies and still sleep at night. But having an army of turnaround kings and AI experts on retainer costs an absolute fortune. Which brings us to our final major topic, the fees we pay for this expertise and how the industry attempts to mask its true performance. Let's dig into performance illusions and agency problems.
The alternative investment industry is notorious for utilizing opaque math to justify its compensation. If you want to invest in this space, you must understand the metrics.
Specifically, we need to understand the war between two acronyms, IRR and TWR, internal rate of return versus time-weighted return.
These are the two primary methods for calculating how much money a fund manager actually made for you. Using the wrong one will fundamentally distort your perception of their skill.
Let's start with traditional private equity. They live and die by IRR. Why is IRR the gold standard for a traditional buyout fund?
Because a traditional PE fund is a closed-end structure that operates via capital calls. It is a highly controlled environment. If you pledge $1 million to a PE fund, the manager does not take your cash on day one. They leave it in your bank account.
Okay.
The manager completely controls the timeline. They spend months hunting for a deal. When they find the perfect company at the right price, they issue a capital call demanding a portion of your money to execute the purchase. 5 years later, when they sell the company at a peak valuation, they return the cash to you.
The manager is the absolute dictator of timing.
Because the manager controls exactly when the capital enters the market and exactly when it leaves, it is entirely fair to judge their performance using IRR. IRR is a money-weighted return. It explicitly measures the manager's ability to time the market, their skill at deploying capital when assets are deeply discounted, and returning it when valuations are frothy.
But BDCs and evergreen funds, like BXSL or BCRED, operate in a completely different reality.
A vastly different reality, driven by the chaotic behavior of retail investors. In a traded BDC, or a continuously offered non-traded fund, the manager has absolutely zero control over when cash flows into or out of the fund.
Right. If the stock market hits an all-time high and retail investors feel euphoric, they might dump hundreds of millions of dollars into a BDC. The fund manager is legally required to put that money to work. They're forced to originate loans at the absolute top of the market cycle when credit spreads are tight and risk is high.
And conversely, when the market crashes and loans are available at incredible discounts, the retail investors panic and hit the redemption gates, pulling cash out of the fund exactly when the manager desperately wants cash to buy cheap assets.
If you judge that BDC manager using IRR, their performance will look atrocious. But the bad timing wasn't their fault. The retail investors made the terrible timing decisions.
This is why evaluating a continuously offered vehicle using IRR is fundamentally deceptive. We must use TWR, time-weighted return.
Explain who TWR strips out the noise.
TWR mathematically neutralizes the impact of the cash flowing in and out. It breaks the fund's performance down into isolated subperiods and links those periods together geometrically. It isolates the manager's pure, intrinsic skill at compounding the assets they hold at any given moment, completely divorced from the irrational timing decisions of the investor base.
So if a wealth advisor pitches you a continuously offered private credit fund and the glossy brochure brags about a massive IRR, you should immediately view that as a red flag. They're using the wrong mathematical ruler to make themselves look better.
You must demand the TWR figures. It is the only honest assessment of skill in an evergreen structure.
Okay, let's talk about the cost of that skill, the fee structure. A very common setup in this space is a 1.25% management fee calculated on total assets, plus a 12.5% performance fee on the profits. Now, the 1.25% base fee keeps the lights on at the skyscraper. It pays the analysts. It funds the legal department. I understand that. But I want to heavily push back on that 12.5% performance fee.
The industry defends it as an incentive fee. They argue it perfectly aligns the manager's interests with the investor's interests.
I'd challenge that alignment. Let's look at the classic agency problem. I'm putting up all the capital. I'm taking 100% of the actual financial risk. The manager is playing with my money. If the manager makes safe, boring loans to highly secure companies, the fund generates a modest profit, and the manager takes a small 12.5% cut.
A conservative approach yields a conservative bonus.
But if the manager decides to gamble wildly, stretching for yield by lending money to incredibly risky tech startups, two things can happen. If they get lucky and the risky loans pay off, The fund generates massive profits, and the manager takes a 12.5% cut of a huge number. They buy a new yacht.
And the second outcome?
The risky loans inevitably default. The portfolio implodes. The investors lose millions of dollars. But what happens to the manager? They don't have to write a check to cover my losses. They just shrug, collect their 1.25% base fee, and move on. It is an asymmetrical payoff structure. It's heads, they win massively. Tails, I lose everything. Doesn't that structure actively incentivize reckless gambling?
The math supports your skepticism. You are describing the exact payoff profile of a call option. When you give a manager unlimited upside participation with a hard floor on their downside risk, you are structurally encouraging them to increase the volatility of the portfolio. Left unchecked, that agency problem would turn private credit into a casino.
So what prevents the manager from pushing all my chips onto black?
Two elements. First, as we discussed with the private equity firms, reputation is the ultimate currency. An asset manager who blows up a fund will never raise $1 of institutional capital again. But more importantly, there is a contractual iron cage built into the fee structure. It is called the high water mark.
Break down how the high water mark leashes the gambling instinct.
A high water mark ensures that the manager is only legally allowed to charge a performance fee on new, unprecedented profits. Let's walk through a timeline. The fund launches with a net asset value of $100 per share. Year one is fantastic. The manager executes brilliant loans, and the NAV climbs to $110.
They generated $10 of profit. They take their 12.5% cut of that $10.
They earn their bonus. The new high water mark is firmly established at $110. Now, year two, a severe recession hits. Borrowers default. The NAV collapses from $110 down to $90.
The manager obviously gets zero performance fee for losing $20 a share.
Correct. But here is where the mechanism protects the investor. Year three, the economy recovers. The manager works tirelessly, executing turnarounds and recovering value. They manage to drag the fund all the way from $90 back up to $105. It is a phenomenal year. They generated $15 of per-share growth.
Do they get to charge their 12.5% fee on that $15 gain?
Absolutely not, because the high water mark is still locked at $110. The manager must earn back every single penny of the losses they inflicted on the investors, pushing the NAV above the previous peak of $110 before they are legally allowed to collect another dime in performance bonuses.
They have to dig out of the hole for free.
Exactly. The high water mark forces the manager to internalize the consequences of a drawdown. If they swing for the fences, take excessive risk, and blow a 20% hole in the portfolio, they might spend the next 5 years working 80-hour weeks for zero bonus compensation just to repair the damage. It radically alters their risk calculus. It forcefully aligns long-term capital preservation with their personal wealth generation.
It effectively removes the casino logic. We have mapped out a massive expanse of this alternative investment ecosystem today. We've gone from the mechanics of liquidity gates to the psychology of pricing, all the way down to the corporate mercenaries deployed to save failing companies. Let's pull all these threads together and summarize what we've actually learned.
It is a complex machine, but the foundational principles are incredibly consistent once you see them.
For you, the listener, if there is one defining takeaway from all the financial architecture and case studies we have analyzed today, it is this. In the realm of alternative investments and private credit, the legal wrapper of the vehicle and the operational ruthlessness of the manager dictate your reality far more than the specific companies they lend to.
The structure governs the outcome.
We saw how the exact same underlying loan portfolio creates two entirely different investor experiences during a panic. If you are trapped in a non-traded structure, the manager will drop the gate, locking your capital in a 5-year queue to protect the remaining assets. If you're in a traded structure like BXSL, you have the freedom to hit the panic button and sell instantly, but you must accept the brutal reality of market volatility, pricing your shares at a massive discount.
And we saw how a manager's operational infrastructure, the ability to deploy turnaround kings to strip down bankrupt aggregators or AI value creators to artificially inflate the margins of a software company, can literally resurrect a dead loan and protect the fund's yield from a default.
The practical application for you is vigilance. If you are out there hunting for yield in this high-rate environment, you cannot afford to just blindly stare at a beautiful 11% dividend yield on your brokerage screen. You have to lift the hood and look at the engine.
You must verify the quality of the math.
Look at the non-accrual rate. Is it a pristine 0.6% or is it a terrifying 4% indicating a rotting portfolio? Look obsessively at the PIK interest. Are they paying your dividend with actual hard cash generated by the borrowers? Or are they borrowing money against imaginary paper wealth to keep the illusion alive? And look at the market pricing. Is the fund trading at a premium to its NAV or a massive discount? And if it is at a discount, does the management team have the balance sheet strength to halt issuance and execute accretive buybacks? Or are they diluting your shares just to keep their fees growing?
Those are the specific diagnostics that separate a sustainable, wealth-generating yield from a catastrophic liquidity trap.
Now, I want to leave you with a final provocative thought. Something to mull over that builds on the structural realities we've established today. We spent a lot of time discussing the 90% rule. BDCs, to maintain their tax-exempt status, are legally forced to bleed out 90% of their income to shareholders. They are structurally forbidden from hoarding cash to build a massive internal war chest.
Which means their primary method of growth is external. They are perpetually reliant on issuing new debt or equity.
They are completely dependent on the global capital markets remaining open, liquid, and functional. But what happens if we hit a true, prolonged macroeconomic freeze? I'm not talking about a quick dip. I'm talking about a black swan event where credit markets completely lock up for years. Banks stop lending. Institutional buyers vanish. No one is willing to buy new stock issuances.
A total systemic seizure.
In that scenario, the BDC cannot refinance its existing debt. It cannot raise fresh capital. Yet, it is still legally mandated by the IRS to continuously flush 90% of its incoming cash flow out the door to retail investors. The fund is bleeding cash by law, with no ability to transfuse new capital.
It creates an inescapable paradox.
Exactly. Does the very legislation designed to protect retail investors, the forced payout rule, become the mechanism that slowly, mathematically starves the BDC to death? Is the traded BDC structure fundamentally incompatible with a multi-year credit freeze?
It is a chilling proposition, a forced liquidation in slow motion dictated entirely by the tax code.
It is something to seriously think about the next time you log in, see that double-digit yield, and assume the math is indestructible. When we talk about finance, we usually expect clean, precise systems. A stock goes up or down, a bond pays or defaults.
But the private markets do not operate on binary outcomes. They operate in the gray areas of contracts and human behavior.
When you step into the world of private credit, you're no longer looking at a clean financial X-ray. You are standing deep in the basement of the global economy, staring at a massive, complex network of high-pressure plumbing. And knowing which valve is real, which gauge is an illusion, and which pipe is about to violently burst, that makes all the difference. Thanks for diving deep with us today.